Oracle stock just closed at like $175.06 after this massive 25 to 30% weekly surge.
Yeah, it's been a wild week for them.
Right. But, when you look past the headlines, you see falling long-term trends, negative free cash flow, and corporate insiders quietly dumping their shares.
Exactly.
So the question we are asking today is pretty simple. Are we looking at a wildly undervalued gem riding the AI wave, or the most massive value trap in the tech sector right now?
It really is the ultimate market paradox. I mean, you have top-line revenue numbers that look like a rocket ship.
What's
Then
up?
the underlying financial mechanics, they look like an absolute anchor.
Which is exactly why we are tearing into it today. Welcome to the deep dive. We've
Right.
taken a massive stack of financial data, technical charts, and analyst reports on Oracle ticker symbol ORCL, and we are extracting the absolute most important insights just for you.
Yeah, we're cutting through the noise.
Exactly. We want to figure out the actual mechanics of what is going on with this tech giant in April 2026. And by the way, by the end of this analysis, I need you to tell us in the comments if you are buying this hype or running for the hills. Hit that like button, subscribe to the channel, and let's get into it.
Well, before we dig into the numbers, we just need to establish the ground rules, right?
Go for it.
We are having a natural human debate about data, psychology, and market mechanics. We are exploring the facts, but, this is not financial advice.
Right. You are in the driver's seat. We're just here to hand you the map. So I want to start with the fundamental trigger for this recent stock surge.
Okay.
Everywhere I look, the news is just dominated by Oracle's new multi-cloud expansion with Amazon Web Services.
Huh.
But historically, Oracle and AWS were like fierce, bitter
Oh,
competitors.
definitely.
Why the sudden team up, and how does this actually work mechanically?
It's a fascinating pivot, honestly. Mechanically, Oracle is embedding its database hardware and software directly into AWS data centers,
Wait, literally inside Amazon's buildings.
literally inside. For a long time, Oracle tried to force customers to move entirely to Oracle Cloud if they wanted the best performance from Oracle databases.
Makes sense. Keep them in the ecosystem.
Right? But the market spoke, and a lot of massive enterprise clients said, no, we want to build our apps on AWS.
Yeah.
So instead of losing those customers entirely, Oracle compromised. They are placing Oracle server racks inside Amazon facilities.
Wow.
And this reduces the latency, the time it takes for data to travel back and forth down to practically zero, which is critical for modern AI workloads.
Okay, so it's an interoperability play. They realized they couldn't beat Amazon's market share, so they decided to become like a toll booth inside Amazon's ecosystem.
Precisely. And when you look at Oracle's fiscal Q3 2026 results, which came out on March 10th, you can see why the market got so excited about this.
The numbers were big.
Huge. Total revenue hit $17.19 billion, which is a 22% increase year over year.
Wow.
But the metric everyone is staring at is cloud revenue.
Yep.
That came in at $8.9 billion,
So that
a 44% year-over-year jump. Cloud now officially makes up 52% of Oracle's total revenue.
over half the business is now cloud. That's a huge milestone.
It really is. And it trickled down nicely to the bottom line, too. They reported net income of $3.72 billion with an earnings per share of $1.207.
Okay.
So by all traditional surface-level growth metrics, those are phenomenal numbers.
Okay, let's unpack this, because looking at my notes, there is a massive contradiction here.
Yeah, there usually is.
If the income is so great and cloud revenue is up 44%, what on earth is going on with the cash flow?
Ah, right.
Because I'm seeing that their 12-month operating cash flow is $23.5 billion, which sounds amazing, but their free cash flow has actually turned negative.
Yeah.
Help me understand the mechanics there. How do you bring in over $23 billion and still end up in the red?
This is where we have to separate accounting profits from actual cash in the bank.
Okay.
Operating cash flow is the money the business generates from its day-to-day activities, selling software, subscriptions, things like that.
And that number's healthy.
Very healthy. But free cash flow is what is left over after you pay for the capital expenditures.
The physical stuff.
Exactly. The physical assets required to keep that business running and growing. And right now, Oracle is engaged in a staggering $50 billion annual capital expenditure push, specifically to build out AI data centers.
$50 billion a year. What exactly does that buy?
I mean, it buys real estate, thousands of miles of high-capacity copper and fiber optic cabling, specialized liquid cooling systems.
Because the servers get so hot.
Right. And of course, massive racks of cutting-edge NVIDIA GPUs. Data centers for AI are vastly more expensive and power-hungry than traditional cloud storage centers.
That makes sense.
So because they are spending $50 billion in cash today to build these out, their free cash flow is negative. The cost of those physical buildings will be spread out over years on the income statement through depreciation,
Oh, I see.
which is why their net income looks great today, even while their bank accounts are basically draining.
Wow. So they are bleeding cash in the present to build a physical foundation for the future.
Exactly.
And to fund this, I'm seeing their total debt has ballooned to somewhere between $149 billion and $162 billion.
Yeah, it's massive.
That is larger than the GDP of a lot of countries. Why isn't Wall Street punishing them for taking on that much leverage?
Well, Wall Street generally tolerates high debt if it's tied to contracted future revenue. They view it as a necessary evil to compete in the AI arms race.
Right.
If you don't build the data centers now, you lose the war. But that debt creates incredible vulnerability if anything goes wrong.
And this perfectly sets the stage for the bipolar behavior we are seeing in the stock price. If a company is bleeding cash to buy servers but making record cloud revenue, it makes sense that the market is having an identity crisis.
Definitely.
I was looking at the charts, and I noticed this massive 52-week swing. The stock has traded as low as $121.24 and as high as $345.72 over the last year.
It's a massive spread. I mean, it reflects total market indecision about how to weigh the explosive AI growth against the crushing debt load.
Right, and here's where I get confused. We just saw this 25 to 30% weekly surge, closing at $175.06 on April 17, 2026.
Yeah.
The daily trading volume was roaring at over 45 million shares, which is way above the 35 million average.
A lot of buying pressure.
Yes. Yet, despite this massive rally, the stock is still 18.4% below its 200-day moving average of $214.26.
Yep.
And the 200-day is supposed to be like the granddaddy of trend lines for institutional investors.
Yeah.
So if volume is this high, why is it still trapped in a broader downward trend?
That is the illusion of short-term momentum.
Okay, break that down for me.
When you look at momentum indicators like the MACD, the moving average divergence, it's sitting at 5.05.
Right.
And without getting too deep into the math, MACD essentially measures the relationship between two moving averages of a stock's price. When the short-term average crosses above the long-term average, it signals a bullish short-term burst.
Got it.
Combine that with a 14-day RSI, or relative strength index, of 59.61. That shows buying pressure is heating up but hasn't entirely exhausted itself yet.
So the immediate short-term temperature is hot.
Exactly. But it's happening inside a much larger, colder room.
Oh, I like that analogy.
Retail traders look at a 30% weekly gain, see the heavy volume, and experience intense FOMO. You know, the fear of missing out.
They just want to jump in.
Right. They assume the bottom is in and the stock is rocketing back to its $345 high. But they aren't looking at the structural technical boundaries.
Meaning the resistance levels.
Correct. Right now, Oracle faces immediate resistance at $178.35. Now, resistance isn't some invisible magical ceiling.
Right. It's not a force field.
It is a literal price point where large institutions, or people who bought earlier, have placed massive limit orders to sell. It creates a wall of supply.
Wow.
Every time the price nears 178, millions of shares are automatically dumped onto the market.
Oh, that makes sense. So retail traders are aggressively buying market orders, throwing their money into the pot, and the smart money is using that exact buying pressure as liquidity to exit their own positions quietly.
Precisely. And even if retail chewing through that supply somehow breaks the $178 level, there is a much heavier major resistance wall at $208.
Wow.
Meanwhile, if this short-term momentum fades, the crucial support levels where buyers historically step in are down at $170.50.
And if that breaks?
If that breaks, the technical charts show a very long, empty fall down to major support around $136.48.
That is a terrifying drop.
It is.
Which brings up a really important question. If retail is buying the breakout, what are the insiders and the Wall Street analysts actually doing behind closed doors?
That's the real question.
Because when I look at the analyst consensus, it's remarkably optimistic. Overall, Wall Street is calling Oracle a moderate buy. Out of all the major analysts tracking it, 28 are saying buy or strong buy, 9 are saying hold, and there's only one sell rating.
Yeah, that is the public face. But if you dig into their actual price targets, the conviction starts to wobble.
It really does. The targets are incredibly fractured. You have RBC Capital putting out a low target of $160, which implies the stock actually needs to drop further from where we are today.
Right.
Then you have Guggenheim throwing out a sky-high target of $400. The average sits around $264, which would be an 81% upside.
Yeah.
And a lot of this optimism seems tied to traditional valuation models. The stock is currently trading at a 31.43 price to earnings, or PE ratio. Some analysts plug in that 44% cloud growth, look at the PE, and conclude the stock is 62% undervalued.
What's fascinating here is how misleading a PE ratio can be in isolation.
How so?
A PE of 31 might look completely reasonable, maybe even cheap, for a tech company growing its cloud segment by 44%.
Sure.
But the PE ratio only looks at equity, the stock price, relative to earnings. It completely ignores the capital structure of the company.
Oh.
It ignores the $162 billion in debt.
So it's like looking at someone driving a $200,000 sports car and assuming they are wealthy, without checking to see if they financed the entire car at a 20% interest rate.
Exactly, and this is the core of the value trap debate.
Right.
A value trap occurs when a stock appears cheap by traditional metrics, drawing investors in, but it's actually priced correctly or even overvalued because of underlying structural issues like massive debt or deteriorating cash flows.
And what blew my mind when looking at the research was the insider activity.
Tell me about it.
If this company is truly 62% undervalued, you would expect the executives to be buying shares hand over fist. But the data tells the exact opposite story. Over the last 3 months, insiders have sold over $8.4 million in Oracle shares.
Wow.
I looked for insider buys during that same period and found absolutely zero.
The timing of the sales is notable, too. Just a day prior to our Friday close, on April 16, 2026, Oracle officer Stuart LeVay proposed selling over 7,000 shares, valuing roughly $858,000.
That is a huge red flag to me. The executives are the people who actually see the $162 billion credit card bill every single day.
Yes, they are.
If they are liquidating while Wall Street tells retail traders to buy, that feels like a classic value trap setup.
It certainly warrants caution. But to be fair to the bull case, we need to understand exactly why some investors are perfectly comfortable ignoring that debt and the insider selling. We have to look at the upside scenario.
Okay, let's play devil's advocate and look at the best case recovery scenario, because the numbers here are genuinely mind-blowing.
They are.
The absolute strongest argument for Oracle right now is their RPO remaining performance obligations. As I understand it, this isn't just projected interest. This is essentially their backlog of contracted, guaranteed future revenue.
Correct.
And Oracle's RPO is sitting at a staggering $553 billion.
Yes. That is a 325% increase year over year.
That's insane.
It is a phenomenal metric because it provides massive revenue visibility. They aren't hoping to find customers next year. They already have the contract signed.
And when you combine that backlog with their multi-cloud strategy embedding into AWS, Google, and Microsoft Azure, they have essentially positioned themselves as a universal, unavoidable layer of the internet. No matter who wins the broader cloud computing war, Oracle gets paid. Because of this, they are boasting a return on equity, or ROE, of 57%. I mean, if I'm a bullish investor, I look at a $500 billion guaranteed backlog and a 57% return, and I am throwing my money at this stock.
But we have to explain the mathematics of that return on equity because this is where the debt comes back to haunt the narrative.
Okay.
ROE measures a company's net income divided by its shareholders' equity. Now, how do you artificially inflate your ROE? You use leverage.
Walk me through the mechanics of that. How does debt juice the return?
Let's say you start a business with $100 of your own money and you make a $10 profit. Your return on equity is 10%.
Simple enough.
Now, let's say you borrow $900 from the bank. You now have $1,000 to work with. You use that to generate $100 in profit.
Okay.
Your profit margin hasn't changed, but because only $100 of that initial capital was actually your equity, your return on equity is now a staggering 100%.
Wow. So the 57% ROE isn't necessarily proof of incredible operational efficiency. It's a mathematical byproduct of the fact that they are operating on $162 billion of borrowed money.
Exactly. High leverage naturally inflates ROE. But the single biggest shocker in the research, the absolute linchpin of the bear case, isn't just the debt mathematics.
What is it?
It is customer concentration risk within that massive backlog.
Oh, this is the part that genuinely terrified me. Let's talk about the $553 billion RPO.
Right. Bulls point to that $500 billion backlog as proof of safety. But roughly 300 billion of that backlog is tied to just one single client.
Wait, one client?
Yes, OpenAI.
Over half of their guaranteed future revenue is dependent on one company.
And we have to remember the financial reality of OpenAI. Despite its massive cultural dominance and soaring private valuations, it is currently an unprofitable company burning through billions of dollars in venture capital to train its models.
Wait, I really need to process this. Oracle is spending $50 billion a year. They are buying land, pouring concrete, securing massive power grid commitments, and installing liquid cooling systems, essentially building specialized multi-billion-dollar power plants and server farms.
Yeah.
And the core tenet they are building all this for is a single company that hasn't proven it can turn a sustainable profit yet.
That is the execution risk in a nutshell.
That's like having a $1 million catering contract, which sounds great, until you realize it's for one guy who hasn't paid his rent yet.
That's a great analogy.
If OpenAI's subscription growth stalls, or if the broader AI venture capital bubble cools down and OpenAI can't pay their bill, Oracle is left holding the bag on hundreds of billions of dollars worth of highly specialized physical infrastructure.
Right.
They can't just easily pivot and sell that customized AI server space to a regional bank.
Exactly. Oracle isn't just flipping a software switch. The physical build-out required to meet these AI workloads is unprecedented. If their execution falters even slightly, or if their primary tenant defaults on those obligations, the sheer weight of the debt servicing will absolutely crush Oracle's balance sheet.
Wow.
They are operating with zero margin for error.
So bringing this all together, what does this actually mean for you listening right now? We've explored the massive AWS integration, the explosive cloud revenue, the terrifying $162 billion debt anchor, the volatile technical levels, and this wild $500 billion backlog that is heavily reliant on one unprofitable AI giant.
It's a lot to weigh.
It is. When we look at the short term versus the long term, what is the actual outlook here?
Well, in the short term, the market mechanics suggest extreme, unpredictable volatility. The technical indicators show immediate resistance, and institutional order flow suggests selling into these retail rallies.
Right.
A lot of cautious, technically driven analysts believe the smartest play is not to chase this 30% weekly surge. The risk of a reversal is too high.
So what do they suggest?
Instead, they suggest waiting for a technical pullback to a more stable support zone, specifically the $120 to $130 range, before even considering a long-term entry.
Basically, let the dust settle and let the momentum cool off before you risk your capital.
Exactly. But if we shift to the long-term outlook, if, and it is a monumental company-defining, if Oracle can execute this physical infrastructure build-out flawlessly, and if OpenAI continues to scale and actually pays out that $300 billion contract, the projections are astronomical.
Oh, who are we talking?
Oracle internally projects that their cloud infrastructure revenue alone will hit $18 billion in 2026 and a staggering $144 billion by 2030.
Wow.
If they hit those numbers, a $175 stock price today will look like an absolute steal in hindsight.
It is the ultimate high-stakes bet-the-company gamble. Which leaves us with this final thought for you to mull over. We've spent a lot of time focusing on whether OpenAI can pay the bill for this massive build-out.
Yeah, we have.
But think about the pace of technological change. Oracle is borrowing over $150 billion to buy today's cutting-edge AI servers and cooling systems. What happens to the global tech economy and Oracle's balance sheet if a new quantum computing architecture or a drastically more efficient chip design emerges in 2 years?
That's the billion-dollar question.
What happens if the hardware they are betting the company on right now becomes obsolete before the debt is even paid off?
It's a fascinating vulnerability. It really requires looking past the quarterly earnings and understanding the physical fragility of the tech cycle.
And that right there is why we do this. The true value of this deep dive isn't to hand you a buy or sell recommendation. It's to give you the mental models to look past a flashy 30% weekly stock surge, to understand the mechanics of free cash flow, and to spot the massive debt-fueled risks hiding right beneath the surface. Don't forget to drop your thoughts in the comments, hit subscribe so you don't miss our next breakdown, and we will catch you on the next deep dive.